Hi, everyone, and welcome to PYMNTS. My name is John Gaffney. I'm Chief Content Officer here. Today, we have a very special event. We are going to discuss the journey to composable banking, very far from a management theory or an engineering white paper. Core banking system innovation is progressing from the mainframes of the branch-based model of 50 years ago to the digital-first embedded finance model of today and tomorrow. Unfortunately, many banks find themselves somewhere in the middle with the ability to customize customer experiences, but falling short on microservices and event-driven solutions. The goal is composable banking. Now, to get there, banks need to move from devices to digital, from hosted solutions to the cloud. But that's only the beginning of the change that will come to core banking architecture. So this roundtable discussion is going to gather 3 expert practitioners of insightful, reactive, and eventually agile and composable banking. And I will introduce them now. First up, Michael Haney, Head of Product Strategy at Galileo. Welcome, Michael.
Thanks for having me, John.
And Phil Rosen, MoneyLion's Chief Technology Officer. Thanks for joining us.
Hi, thanks very much for having me today.
And Varo Bank Chief Technology Officer, Sachin Shetty. Thank you for joining us, Sachin.
Thanks, John. Really happy to be here.
So, Michael, we're going to start with you. Tell us a little bit about how Galileo plays in the composable banking space. And I'd like you to settle some terminology. Let's talk about what the core banking architecture of a modern bank looks like and how it's changed over the years.
Sure, John. This is a really timely question because many banks are finally making some serious effort to modernize their back-end account and transaction processing systems. And as you mentioned, Galileo has a number of solutions in this space, supporting deposits and payments and lending solutions in this so-called below-the-glass space. And these banks, they've watched with interest at what the digital challengers have done with the latest technology. Perhaps these banks have even been supporting them as being their partner bank in a sort of banking as a service business model. Some of these banks have also experimented themselves with building so-called digital sidecars on a modern tech stack, or maybe they've modernized another part of the bank, such as their payment infrastructure. And these experiences have taught them that the latest generation of core processing solutions is ready for prime time. And it's becoming almost an imperative to improve the operational efficiency at these legacy banks and be more responsive to client needs and industry trends. This new generation of platforms, to more specifically answer your question, is based on what we refer to as MOC principles. This stands for microservices, APIs, cloud, and headless. So we start by creating a reusable library of more granular building blocks, and we can use these to build core services that will help to break down those traditional silos that we see in the bank's design or even their system designs and create some new and exciting offerings. We expose these through APIs to ease that integration to other systems. And then we deploy them obviously on the cloud to take advantage of that elastic fabric of the cloud so they can scale more easily. So another aspect that we look at when we look at modern systems is that they're lean and referred to as headless, right? They primarily serve as the system of record for customer accounts. They efficiently post debits and credits of all types, but they let other systems in the ecosystem play the role that core processing technology is often not best suited for. So Gen 1 systems, which really emerged way back in the late 1960s, they're all built on mainframe technology. Gen 2 systems started to embrace a service-oriented architecture, but they were still too coarse-grained and they weren't really designed to integrate the bank into external systems over the internet. So this latest generation of systems really is about, enabling that digital-first client servicing in real time, enabling staff to have that mindset of continuous development and delivery, and then, of course, consumption-based vendor pricing. So that's really how we define this new era.
So, Sachin, let's go to you now at Varo Bank. So Michael mentioned Gen 1, Gen 2, Gen 3 architecture or coding, I think, as you referred to it. Could you tell us how the differences show up in the banking experience? What does the consumer see about those differences?
Yeah, and I think Michael answered this well. When you think about Gen 1. It essentially goes back to the 80s and the Bruce Springsteen era, at least, I'm dating myself here. But Gen 1 cores were like old school, custom built mainframes, built in COBOL, assembler, monolithic systems with interdependent modules for customers, transactions, products. Expensive to build and maintain, but extremely reliable, right? Then in the late 80s, early 90s, technology evolved. We saw the emergence of Gen 2. Now, Gen 2 brought modularity to the core because they were built using, if you recall the term N-tier architecture, which refers to a pattern of, decoupling the front end from the middle tier business logic and the back end layer. So they were more product centric in that sense, more configuration driven cores that allowed the market to expand to regional and smaller banks since they were less expensive. And you could build and run them at a cost lower than the Gen 1 cores. Then around the 2010s, as technology evolved and standardized around REST and JSON for data interchange and integration, API and cloud became a forcing function that drove changes to Gen 1 and Gen 2 cores, and decomposition became a viable strategy. And most of Gen 3 is built as microservices, where your decoupled business capabilities like customer and account management, transaction processing, statements, reporting. And a lot of Gen 2 providers, what they did was they developed cloud versions of their popular core applications as Gen 3 cores. And then the obvious next evolution of the Gen 3 cores is composable banking. And at least the way I differentiate the composable banking-based cores from the Gen 3 cores is these are like truly cloud native cores. They've been designed from the ground up, built as microservices. And it's very akin to Lego blocks where you can take the pieces you want and build the solution you want. And you don't have a lot of legacy debt that you deal with. So what that means for Varo and for our customers is we get to choose the parts of the core that give us the highest leverage in our build versus buy decisions, right? So we can leave the commonality of what the core does and leave the best of that to the core. And we can focus on building for ourselves the unique experiences and the products that our customers need that most other banks and financial institutions cannot offer. So it's that composability that Mike talked about, that has allowed us to do that, build those experiences for our customers. And, one of the products that a couple products come to mind. One is Varo Advance, which is our short-term loan program, which we have built in-house, leveraging, some of the composability that we have, and Varo Line of Credit, which is an upcoming product we have for a short-term installment loan that we are, about to release. So that's essentially how these, how this, I would say, changes are reflecting in the products that Varo's putting out.
So Phil Rosen, CTO at MoneyLion. How does composable banking show up in the MoneyLion experience? And I know you guys have had an amazing journey from being just a neobank to being really a mall for financial services. So how does it show up in MoneyLion?
As both Michael and Sachin really said, it starts with having the core functionality sort of below the waterline, the invisible pieces of it, start with APIs and treat them as Lego blocks, right? Where you can pick the pieces that are best suited for you. A good chunk of those are going to be first-party microservices that are really doing the thing that you do well in a differentiated way. And then composing those with elements from other systems, third parties that add on that extra functionality that seems more like a commodity tool that enhances what you're able to do. What that translates to within an application like MoneyLion is there's a set of things which we do entirely in-house very well, better than anybody else. And then we augment those with the different additional products and services alongside it from third parties that really enhance it. And we start to extend that not just into the functionality we provide, but also into the experience that the consumer has. It's not just about us trying to do one product as well as we possibly can in-house. It becomes increasingly about how do we deeply bring in third-party products into that experience, right? And work towards sort of a checkout process where, we're really indifferent if it's a MoneyLion product being consumed or a third-party product. We want to be the place where the consumer makes that decision. The composable banking strategies make that really viable in a way that wasn't before. Previously, when you're looking at bringing in third-party products, you're talking about advertising. But in this new era, you're not talking about advertising. You're actually bringing in the personalized products that are tailored to the consumer needs, that meet a very clear requirement of the consumer and are solving their problem in a way that traditional banking or even the first wave of neobanks are unable to do.
Okay, interesting. So, Michael, let's go back to you. In preparing for this this roundtable, which is just fascinating topic to me. It struck me that we're talking about technological change, yes, but a mindset change as well. Would you agree with that?
Yeah, 100% agree with you. Sorry about that. As an ex-banker, I witnessed that for well over a decade, as internet banking took hold, that banks embraced the concept that we called two-speed architecture. They were pouring all kinds of money into launching web and mobile channels for customer self-service or even remote employee work. They embraced new ways of working around continuous development and delivery, so-called agile methodologies, DevOps methodologies, in order to speed up the number of releases and bring new capabilities to market more often. And they were happy to let these back-end system teams, the below the water, below the glass teams, continue to support their mainframe-based platforms, work at slower speeds, waterfall development life cycles. But eventually the bank would hit a wall. They realized the next step of what they wanted to do was launch a new product, and that required back-end changes. But these teams in the back end couldn't operate with the same agility as the front end team. So there was a huge disconnect there. Eventually, these back end teams also started to retire. The know-how to maintain these older systems was disappearing, and that introduces a whole new risk to the bank. And consultancies were happy to take over the maintenance of these systems, but at a much higher cost, right, than the banks were used to. So time to market for changes, total cost of ownership, and now reducing risk, they continue to be among the top drivers for core modernization, payments hub modernization, all these back-end systems. And due to these factors, we're even now starting to see investors and regulators pressure the banks to modernize, even beyond some of these other factors.
Interesting. So, Phil, is this, from a technological standpoint, is this a generational change in your opinion?
Yeah, I think so. And I think it's not just from the tech side. I'll talk about the tech side too. But one of the things that's notable to me is when I started Even Financial in 2014 and 2015, and I talked to banks about having them embed their products deeply within third parties, the reaction was terror, hostility, and avoidance. And that has radically changed in the 10 years since. Now they're all trying to figure out how to do that. So that reflects a really big mind shift change in just the banks. And it's across size, right? That's from the biggest banks down to the smallest regionals. As you can see with our partnership with EY, where we're really supporting EY's clients on a generational change in the technology they integrate. In terms of the tech, I think we are in the midst of a pretty big revolution that especially is, I really think, starting to take momentum in the last 2 years. I think the fact that, we've had to see these a lot of businesses in fintech focus on profitability and lower costs has meant that there has been an acceleration in actually making this tech work to actually engage and make consumers profitable, as opposed to just sort of drive that initial scale. And I think that's a really different thing, because right now, all of our clients are looking at how do we really look at ARPU and LTV over time? How do we get the data to do that? And then how do we get third-party integrations into our own experience in order to actually protect and grow that? And that is having impacts all the way down the tech stack, as regional banks and other banks are now much more willing to work with us on integrating our technology, bringing in the new technology and combining it with the legacy technology.
So, Sachin, what's your experience here? Do you think this is a generational change?
No, absolutely. Phil is spot on. As you think about, the customer today, a lot of our customers have grown up mobile first, and they're extremely tech savvy. So they expect to be served by a modern tech-friendly bank with fast access to their money and financial services that meets them where they are and not in a bank branch. And we at Varo, we embrace that ethos, right? And I'll give you an example of one of our non-traditional products they built to serve our customers. So We recently announced, as I mentioned, our brand new product called Varo Line of Credit, which we've just released to our first set of waitlisted customers, a short-term installment loan that's designed to help customers with unexpected expenses, and it offers them a set amount of cash ranging from $600 to $2,000 with a fixed one-time fee and no interest. And all a customer has to do is few clicks in the Varo app, you are approved and you see the funds in your account. No need to go to a branch and you have the funds with no fuss. Now, what enables an experience like this is the composable architecture that we've been talking about, because it allows us to ideate and innovate for our customers while keeping the cost to serve really, really low. So these are all the advantages that we can take advantage of as a tech bank that I would say, those opportunities didn't exist in the past.
Sachin, am I right in assuming that before this technology and this architecture became available, that some of the products you just described would not be possible?
It would be very difficult to deploy them at scale and at the time that the market demands, right?
Yeah.
Because when you need, what composability allows you to do is build on top of what already exists, right? And you can add differentiating features at a much faster pace than you would be typically been able to do. So yes.
Can I add to that?
Yeah, absolutely. So I was going to ask you the same question.
When we look at our earned wage access product, which is doing incredibly high volumes of consumers, right? All of that has to be really heavily automated. And making that profitable wasn't just a question of like having good models and good underwriting. It actually required a ton of work to optimize how we would do payments and distribution and collection, a ton of work to optimize the servicing process, a ton of work around bringing in a variety of identity verifications and third-party systems, right? Like, it's not the underwriting that actually makes it successful. It's actually composing a system across really dozens of first-party and third-party services that actually makes it work and profitable at scale. And it would be impossible to do it otherwise, actually, without composable banking practices.
Absolutely.
So, Michael, Sachin, thank you. Michael, let me ask you the same question, though. I'm surprised at the enthusiasm behind Sachin and Phil's answers. Are there products that could not have been launched that are now launched because of composable banking?
Yes, both from technological restrictions or cost restrictions, but also referring to that mindset that you referred to earlier on this call. A lot of legacy banks continue to live in these silos, right? This is my payments business. This is my deposit business. This is my lending business. And so, they embraced what we colloquially call Conway's Law, right? The org structure defines the system architecture as well. And to be fair, a lot of regulators still like to regulate based on the product line. So what I like to call combination products like early wage access or buy now, pay later or things of this nature, really help to break down those silos. And the newer platforms allow that sort of assembly, as Sachin mentioned, the building blocks, right? When your Lego blocks are microservices, you can assemble these new experiences more easily.
So let's stay with you, Michael. You mentioned some of the legacy banks. How are they approaching composable banking, and do they need to be more aggressive?
Yes. So unlike our friends Varo and MoneyLion on the call today, most legacy incumbent banks and credit unions are on older platforms. They want to change. They want to be as nimble as these guys, but they often don't know how to get started, or their core processor really doesn't lend itself well to picking and choosing the capabilities you want. It's kind of an all or nothing package. So really the first consideration as you present the case for change to your management team or to your board is not to make this solely about technology, right? Let's create a business case that encompasses things that the business side of the house cares about, things like revenue and profit. And this is why many banks will start to experiment, right? They'll create a new offering or they'll target a new customer segment on a new tech stack. This allows them to sort of test and learn, right, in a way that keeps the business side of the house happy because they're now attracting these new customers or they're gaining revenue from these new products. Once they've now proven, right, that this new platform helps to reduce total cost of ownership, time to market, all these factors, then they become more open to modernizing their legacy business and embracing that composable mindset. So these, these iterative and progressive approaches to change, product by product, segment by segment, market by market, are really the approach they like to do to de-risk the whole program. And nobody really does these big bang transformation programs anymore. The goal is at each step of the process, bring business value, bring customer value to the table. That creates momentum to the next phase of the project.
So as Michael mentioned, we have a pretty amazing group gathered here today, and I want to take advantage of that and ask a bit of a trick question here, and I'll start with you, Sachin. Let's say we were keynoting a banking conference. What would the business case be? What would 2 or 3 takeaways be for the business case around composable banking?
Yeah, and I think Michael's hit a lot of the high points on that one. As it's more of a mindset and an organizational shift than anything else. So what, in my mind, the way I anchor it on is it's based on the principles of the Agile Manifesto, right? Which is focus on collaboration, iterative development, and continuous improvement. So when banks can do this right, they can leverage a lot of benefits, which include like faster time to market, improved customer experience, better operational efficiency, and much better and an engaged workforce. So I would say if there's a few takeaways to take from that is this has to be a culture shift. So you have to focus on your organizational culture. So this has to start right at the top. Your leaders need to champion the mindset and create a culture of experimentation, collaboration, and continuous improvement within the org. And you have to coach your teams through it. The second thing I would say is, you got to think big, but you got to start small, right? You got to identify what your quick wins are, form your cross-functional teams, build momentum, but go after bite-sized goals, right? And you'd be very surprised at how quickly those wins start to add up. And the third thing, which sounds like a no-brainer but bears repeating, is be very data-driven in your decision-making. And what that means is measure your progress, establish clear KPIs and success metrics, and not just establish them, make sure that you're reviewing them with your entire organization periodically, that you're retroing what's working well, what's not working well. Because more than the continuous improvement, your continued commitment to this change is what's going to drive changes within your org.
Interesting. Phil, how's your keynote sound?
Yeah, I would think I would start a little bit with the landscape and sort of remind many of the banks, the bulk numerically of banks, of where we are right now, which is the largest banks have started to recognize what they have to do differently and are doing it. And they have the capital to do it well, and they're committed to it. It might be more expensive, but they can spend the money. When you start to look at the smaller mid-sized banks and regional banks, they don't necessarily have the in-house tech capability to take any of this through, right? They've been outsourcing a large component of this work to other players. And so, they have to move relatively quickly to figure out how they can start build some of that expertise in-house and what that means in terms of where do they want to focus that they're going to own and be best at, and where are they going to look to bring in third parties to augment them and enable them to do the things that they're probably not going to have the time or resources to invest in. Because it is imperative that they change, right? Every consumer is expecting a digital-first experience. Yes, they still like branches, but they expect to have a full-service digital experience that covers much more than what most mid-sized and regional banks are currently able to do today. So those banks have to get much better at what they're good at and do that quickly, and then figure out how they're going to participate via partnership in a bigger ecosystem to get to the same level of capability and excellence as their larger peers will be soon.
Michael, you get the last word. Your keynote.
Yeah, I would start with saying that core transformation doesn't have to be this big all or nothing high risk proposition. With the more modern, iterative and progressive transformations, our test and learn approaches, and the ability to do a multi-core best of breed solution adoption, that will make this journey less painful for those guys who have to try to grow from an incumbent legacy system. Second is focus on what the technology enables rather than the technology itself, right? A more connected solution, it supports agility, in a rapidly changing world, right? That the more easily it enables that on-demand performance. What is it giving to the bank and to the bank's customers rather than just that's new and sexy tech? And lastly, like shift your attention as a whole bank, that whole mindset shift that we're talking about, shift your attention to more value-added work, right? Customer engagement, product innovation, risk mitigation. This is really where the bank should be spending its time. A lot of this back office processing can be automated. It's highly commoditized today. Embrace the fact that there are newer solutions that can do this better in a fully automated way and maybe even outsource it, right? So I think that's the mind shift that the banks really need to embrace today.
Okay, that's a wrap. And that's been an amazing roundtable. I'd like to thank my guests first, Sachin Shetty, CTO Varo Bank. Sachin, thanks for joining us.
Thank you, John. Thank you for the opportunity. Great conversation.
And Phil Rosen, CTO at MoneyLion. Thanks for joining us.
Thanks very much, John.
Michael Haney, Head of Product Strategy at Galileo. It's been awesome. Thank you very much.
Thank you, guys. It's been a great talk. Thanks.
Absolutely. See you next time.